Good afternoon, everyone, and welcome to the Inside ETFs Canada webinar series. We'll be starting part 3 of our 5-part webinar series in just about 2 minutes. We want to allow those folks that are dialing into navigating a challenging bond environment, strategies and solutions explained, the opportunity to do so. So bear with us. It should just be about a minute or so while we allow those folks that are dialing in to get in. So thank you for your patience, and we'll be back in just about a minute. Thank you, everyone, for your patience. It'll just be about another 30 seconds or so while we allow the last few people to dial into today's webinar. So like I said, we'll get started in just about 30 seconds or so. Thank you for your patience. Hello, everyone, and welcome to today's webinar, Navigating a Challenging Bond Environment, Strategies and Solutions Explained. This is part 3 of our 5-part Canadian webinar series focused on ETFs and getting advisors answers in this time of uncertainty. My name is John Swolz. I'm the CEO of Inside ETFs, and I'll be your host for today's webinar. As fixed income ETFs gain popularity, many advisors are asking how best to utilize them. With central banks across the globe printing money, how are fixed income assets responding? Over the course of the next hour, we hope to answer those questions and many more to help you better understand the current landscape for bond investors. We will hear insights on the current domestic outlook as well as how the global fixed income market is taking shape. For those of you who may be new to bond ETFs, they have exploded in recent years, ramping up in 2018 with their real breakout year being 2019, as inflows pace that of equity ETFs. While fixed income ETFs were late to the party, investors are waking up to their ease of use, the liquidity they provide, and maybe the most important is the time saved that they offer, allowing money managers and advisors to get diversification within their bond portfolio with a single trade. This truly is an exciting pocket of the ETF market and a place I constantly watch for real innovation and expect to see lots of innovations within this format as we move forward, especially as we come across ESG, fixed income ETFs, and more. But I'm lucky today to be joined by a global investment giant in Franklin Templeton. They cover almost all global markets, allowing us to cover both the domestic and international market from a fixed income standpoint over the course of the next hour. I would love to jump right in, but we do have a few housekeeping items to go over to enhance your webinar experience. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer them live during the webcast, but if a fuller answer is needed or we run out of time, our speakers and sponsors will do their best to follow up. We capture all questions. You can expand your slide area by clicking on the maximize icon on the top right of the slide area or by dragging the bottom right corner of the slide area. I'm always asked, will an on-demand version of the webcast be available? Yes, one will be available approximately 24 hours from the conclusion of today's webinar. You will receive an email, but you can just as easily access the on-demand webinar using the same audience link that you used to join us today. So now, on to our webinar. As I said, I am pleased to be joined by 2 industry experts with a mountain of experience in bond investing. John Beck is a Senior Vice President and Director of Fixed Income in London for Franklin Templeton Fixed Income Group. In this role, he coordinates the London-based fixed income teams that manage the group's European fixed income and emerging market debt opportunity strategies. Mr. Beck is the lead portfolio manager responsible for global aggregate strategies and manages portfolios for major institutions, including multinational pension funds and supranational organizations. He is a member of the Fixed Income Policy Committee. Prior to joining the firm in 1990, Mr. Beck was with Saudi International Bank. Mr. Beck holds an MA from Exeter College, and that is part of Oxford University. Our other presenter today will be Tom O'Gorman. He is a Senior Vice President, Director of Fixed Income at Franklin Bissett Investment Management has been with the organization since 2010. Mr. O'Gorman shares co-lead responsibilities of Franklin Bissett Income Strategy Development and Implementation, including Franklin Bissett Core Plus Bond Fund, Franklin Bissett Canadian Balance Fund, Franklin Bissett Canadian Bond Fund, and the Franklin Bissett Monthly Income and Growth Fund. Prior to joining Franklin Bissett, Mr. O'Gorman spent 20 years managing U.S. and Canadian fixed income. He spent 10 years with Prudential Financial as an analyst and was the head of portfolio management for Munich Re in NYC for 10 years, overseeing a $30 billion portfolio of Canadian and U.S. fixed income assets. As I said, you can see a mountain of experience between those two gentlemen. And I was talking with both John and Tom earlier, and we have lots to cover. Today's webinar will be very conversational in nature, but with that said, again, I would encourage you to please submit your questions as you have them. We will try and answer them on the fly as best we can, but if not, we will do our best to get to them at the end. John and Tom, I'm excited to get started. Are you ready?
Sure.
Yep. All right. Well, great to have you guys. So my first question as we dive right in is actually for you, John. As we continue to experience the impact of the global pandemic, when we look specifically at Europe, both from an economic and political standpoint, it appears to be a bit of a mixed bag. Can you share your perspective on the continent?
Yeah, I don't know whether the question is coming to me because obviously the pandemic has worked its way east and you know, we kind of kicked off in Europe and hopefully we'll be moving on from where we were. But, you know, obviously, you know, any kind of league table of who's done well in this is not a league table you want to feature in. You know, I think far more of an issue has been, to a degree, the political and central banking response to the crisis because, you know, clearly it started in Italy. Germany has had a very different outcome, at least in terms of the pandemic. And to a degree, as European economies are now still, you know, partly shut down and the tourist season, which is very important for some of the more southern European economies, is still subject to some question marks. You know, there is that question in terms of, you know, European unity. And I think that, you know, whether you think in terms of, you know, Canadian states, Australian states, so on and so forth, you know, people have described this in some sense, you know, have we seen the Hamiltonian moment in you know, the ECB having to step up to actually really acknowledge, and obviously we've seen the German Constitutional Court kind of pushing back, I suppose, more to the politicians in Germany and saying, well, you decide, but we think that there is more likely this, you know, crisis clearly has pushed forward on the agenda, you know, what does it mean to be European? And I think that the ECB, at least so far, has stepped up very forcefully. And although clearly there has been volatility in some of the spreads that we've seen in European sovereigns from the beginning of the pandemic as the economic impacts have been impacted, I think that, you know, what we've seen in the last couple of months is a far greater degree of stability. And some of those signs, I think, are really quite encouraging.
Well, Tom, let's jump quickly across the pond there. What are your thoughts, and what are you seeing in Canada, and maybe a little bit more broadly North America? You know, especially in response to the question, or in regards to the question I just asked of John.
Sure. Thanks, John, and thanks everybody for joining us, whether it's your morning or afternoon. We know you're busy. I just put up this uncertainty index from Bloomberg, just simply to lay the table for where we are and some of the things, you know, my colleague John just talked about. But this is just an index of business conditions, consumer confidence, leading indicators, and things like that. And it's easy to see from the graph that uncertainty today is higher than it ever was during the great financial crisis, you know, the Euro crisis that followed it right in 2000, say 11, 12, that period there, the energy crisis of 16. And, you know, not surprising that, you know, with the global economy basically mandated to be shut down because of the pandemic, that would be the case. But I just want to, you know, to keep that in mind as we go through the rest of the slides and talk about things, because if uncertainty is high around growth, employment, and earnings, you'd expect that to sort of correlate with where financial markets are and prices are, and that's something we'll talk about a lot. But in Canada, and let's talk about Canada and the U.S. just on this second chart. I mean, we got first quarter GDP from both Canada and the U.S. Canada was down about 6%, the U.S. close to zero. These numbers don't mean a lot because the real quarter that's going to matter is going to be the second quarter that we're almost all the way through. And expectations are, I mean, they're all over the map, but for the U.S. it's going to be down 35 to say 40% quarter over quarter annualized. That's a big hole. The full year, the expectations are minus 6%. For Canada, the same thing. The second quarter is expected to be down 40, and for the full year, Canada's supposed to be down 7. I would just counsel that these numbers are highly subject to revisions or changes. We saw last week with the U.S. employment report, the consensus was for a loss of 8 million jobs, and it came in at plus 2 million. So that's to be expected. The point I really want to make for Canada, though, is it came into this from a position of weakness. It didn't come into the crisis from a position of strength. Just looking through March at where consumption was heading, on the left chart there, manufacturing inventory to shipments, we had more inventory versus what was being shipped than even what was built during the financial crisis. And this is just going to get worse. The handoff from all things housing and consumption related to exports and capital investment really hasn't happened. You'll see capital investment on this next chart. Really can't see the full impact of what we're supposed to see, but you can also see on the right side final domestic demand. So just laying the table, Canada did not come in this from a position of strength. It's going to be a big hit. It's going to have ramifications on deficits both at the provincial and federal level. In the U.S., it's going to be a big hole as well. I think the U.S. started a little bit stronger coming into this than Canada did. But that's really the backdrop. Uncertainty is extremely high. I skipped over the inflation chart just because, inflation is something that we'll be looking at and worrying about. Right now, prices are falling. The U.S. CPI yesterday was down, core inflation down to 1%. But really where the inflation is and what we've seen for most of the post-crisis period is asset inflation. And obviously, as we go through the questions here, we're going to touch on that a lot. So why don't I just pause there, John, and turn it back to you.
Yeah, and I want to ask a follow-up to you guys, and I don't know if this is something, either one of you might not be comfortable answering or whatnot, but do we think that central banks globally have done too much too fast? Do you think they've had the right response? Sort of what tools might they have left, should the crisis get worse?
Well, let me follow up on both some of the things that Tom was talking about earlier, and also take that question. I mean, I was really pleased that Tom put up the Bloomberg uncertainty index, because I've been using this quote quite a lot of late from a French philosopher. It's from Voltaire. He says, "Uncertainty is an uncomfortable position, but certainty is an absurd one." And I think really that is the point. Central banks have done, they almost, in a sense, since obviously it's a medical crisis, they've done the Hippocratic thing. They have done do no evil. They have done everything that they possibly can to avoid compounding the problem. You have a sick economy, you have a sick patient, you have to basically, just throw everything at it. And I think they've been very clear that, the size of what they have done, has been extraordinary. Multiple digit percentage of GDP, bigger than what was done in the global financial crisis. And yet, again, I think we think in some terms, of, is this kind of Keynesian fiscal stimulus and the economy is going to be subject to huge inflation at the outcome. And I think that, come back to that quote, that, certainty is an absurd one. We simply do not know what the employment impact of this will be. Behavioral economics, I think, has got a lot, to help us with. We don't know. We'll have to see. And I think the central banks have been very clear that they stand ready, if need be, to do a lot more. So, I think that, there is a slide later on in the deck, we are from the Fed, or there's a classic sort of thing about, the central bankers convention as they're in Jackson Hole, and they're on a raft down the river, and someone says, "Oh, we're coming out to the rapids," and he says, "Don't worry, I'm from the Bundesbank." And I think that, really we are looking at central bank response to at least bridge over this uncertainty during the pandemic as closed down the economy, as Tom has said.
Thank you for that, John. So, Tom, I want to jump back over to you and in North America, right? So in response to the economic fallout from the pandemic, several countries around the world pulled a page out of the QE playbook, with some buying short-term investment-grade bond ETFs and other ETFs. Can you speak to kind of what the impact is going to be short-term as well as long-term for these types of strategies?
Sure. Thanks. That's really the most important question and thing we're going to discuss. I think what's amazing, and I pulled this chart from a firm we talked to called Hedgeye, based in New York, because the response has been really incredible. The speed at which things have moved has been really incredible. If you go back to the financial crisis, things started in 2007 with the Bear Stearns, some of their hedge funds, and it really developed over a multi-year period, 2000, 2008, and then in September of 08, and then we hit the lows in March of 09, and then the mending and the recovery started. This has all occurred in a matter of months, and what I say is this: the response from the Fed has just been, way beyond what they did during QE 1, 2, and 3 during the financial crisis. There's all sorts of programs supporting corporate bonds, collateralized loan obligations, ETFs, including high-yield bonds, and the capacity for what they can do is really quite large, and they've barely even touched on it. Canada has some buying programs, but the Canadian program really seems just at making sure that markets are functioning. They didn't really step in to buy in a way that the Fed did, which I would call a bazooka, where the response by the markets to what the Fed did without even really buying anything has been phenomenal. And I'll just move to this chart. And I know this is a busy chart, but let me just quickly walk you through it. So year to date, the blue line is just investment grade spreads on corporate bonds in the U.S. on the right hand side, and the green is high yield spreads. And you can see, we were just humming along sort of into March of this year. The global shutdown happens because of the pandemic, and we very quickly widened to 1,100 basis points on high yield and about, say, 350 basis points on IG. The Fed announces these programs, and we've retraced. I think in investment grade, we've retraced about 3/4 to 80% of the widening, and we haven't even seen what the real economic impact is going to be. So, when I go back to that uncertainty index, when I think of uncertainty being really high, you expect volatility to be high and you're going to get compensated. But the Fed has really come in and really sort of pushed spreads tight. If you think of a corporate spread as being a measure of default risk and the likelihood that you're going to be able to get paid back as a lender when you buy bonds of a corporation, that's a measurement that when markets are functioning normally that you can sort of rely upon. When the central banks start targeting prices and perhaps targeting spread levels, which we can argue whether they're doing that or not, the measurement of that normal function of credit risk and other sort of measurements becomes less of a guide as it's been. And then the other periods, I just had the 5-year period just so you can see the magnitude of the move on the upper right-hand side versus the energy crisis, and then as well during the financial crisis. So in this instance, spreads gapped wider, nowhere near where they went in 08, 09, and have snapped back much faster. So the speed has just been phenomenal. So it's interesting because if you go back to the growth that I talked about, where we expect GDP to be, the hole is going to be much greater than it was during the financial crisis. I mean, even if you take the estimates today of down 7% for the year, that's worse than where Canada and U.S. GDP was back during the financial crisis. Yet, when you look at these spreads, and that's the price that you're getting paid for taking the risk, the Fed has really done an extraordinary job, but valuations, and we'll talk more about this, aren't perhaps as attractive as they were some bit ago, having recovered so much. So let me just pause there. That was quite a mouthful, and we'll continue the conversation here.
Yeah, Tom, I'd love to give you a break, but I actually have a quick follow-up question for you there. So you said the response by the Fed so far to the COVID pandemic has been massive and dwarfs, I believe what you said, what we saw in 2008. Are there any other differences outside of the size between the two?
Well, yeah. I mean, QE 1, 2, and 3 was really focused. I mean, again, the crisis was different. It was really a mortgage-driven housing crisis. Bank, we needed to put our arms in sort of around the banking system and corral that in. Here, you just have a government-mandated pandemic where all economic things have slowed down or ground to a halt. So instead of just buying treasuries and mortgage-backed securities, which they're doing, and remember, the Fed's balance sheet never really came back down after the 08-09 crisis. It got up to about $4 trillion. They started to taper it down, and here we are again, and it's going to explode. It may be $8 trillion to $10 trillion when this is all said and done. But there's other facilities here. As I mentioned, there's an asset-backed facility that can target collateralized loan obligations, which gets to the high-yield loan market in the U.S. There's a municipal bond liquidity facility. When we think about deficits and we think about the whole and how municipalities or provinces came into this, it wasn't necessarily from a unlevered position of strength. There's Main Street programs with the payroll protection plan. There's money market facilities. There's corporate bond facilities, ETF facilities, central bank swap lines. They threw everything at this. I don't think it's necessary to go through the whole alphabet soup of all the different acronyms. The only thing I'd say for us in Canada, the response is not a bazooka. It's probably more of a pistol. But Canada, like always, benefits from the actions of the Fed, and Canadian credit markets have benefited from what I'm showing you here. The spread moves would be almost identical, maybe a little bit slower in Canada. So it's really been a response that's unprecedented for sure, and it's the goal was to get bond markets and credit markets working again. They've been resoundingly successful because supply, the selling of new issue bonds in U.S. dollar markets is at record levels. Through early 2020, U.S. dollar credit markets have sold over $1 trillion of U.S. dollar investment grade bonds, where normally that would take a full year to happen. It happened in well less than 2 quarters thus far. So they really have been successful. The only issue is, are you comfortable how you're being compensated, the risk return backdrop for credit and other things. So let me just end there because, we'll continue on with this same narrative.
Yeah, and thanks for digging into those differences. It's great to have that highlighted so people can really understand what central banks might be doing relative to what they've done in the past and sort of help guide their investment strategy going forward. But I do want to bring John back into the fold here because, John, if we're being honest about this, right, COVID has obviously gathered all the headlines, but there's been other impacts and other events to the fixed income market. For example, there was trade tensions, there's been an oil crisis, et cetera, et cetera. How are they impacting fixed income markets as well?
Yeah, well, of course, when we're investing globally, we've got all manner of global things to worry about. We've got currencies to worry about, we've got sovereign spreads to worry about, we've got corporate spreads to worry about, shapes of yield curves, you've got all of those sorts of things. And, one could start with a long list, but, oil is obviously, very important for the Canadian economy. I mean, we are in our benchmark 90 to 100% hedged, back into the Canadian dollar. So, even there, I don't know whether the oil price at -$6 or whatever it was that it closed at in the West Texas in that crazy month of March, was more mad than the Canadian dollar trading, upwards of close to 150. So, there's been a lot of dislocation. But I think, the most important thing from a global perspective, at least in the fund that we run, is that we're hedging most of that currency back to the Canadian dollar. So we've kind of ridden most of that, slight crazy volatility, and it's good to have the chart of high yield and investment grade because, just as Tom described, in the North American markets, we've seen much the same sort of thing in corporate markets outside of the U.S., in sovereign spreads outside of the U.S. And I think whether you look at the year to date, the kind of the 5-year period or whatever, what really jumps out of the page there is try to avoid doing the stupid. There are lots of things that, you can look at and think, well, actually, I really didn't think the oil price was ever going to be negative. I mean, as you very generously said, I started out in the mid-1980s when the oil price, I think, was probably about $8 a barrel, and I think the peak is about $148 a barrel. And I've long learned not to predict what the oil price should be. So, those are the sorts of things that, the market, in a sense, is a weighing machine. You don't necessarily need to trade. And I think the avoidance of the stupid quite often has been the most important thing. So, our turnover actually has been pretty low. I think there are some fundamental questions, clearly, will, to a degree, if you have small positions as we do, some positions in some semi-emerging markets, will the global growth outlook, the deterioration of that impact upon them? But we have seen a very significant drop in prices in some of those areas and subsequently a strong recovery. And I think important has been, stick at your knitting, make sure that the reasons that you invested in some of those areas are still current, and provided they are, to stay, with where we have been invested, and broadly speaking, that has been the appropriate thing to do. So yeah, there've been lots of things for us to worry about. Oil prices is just one of them, obviously very pertinent from a Canadian perspective.
Yeah, and Tom, anything to add to that outside of the oil crisis?
Yeah, I mean, Canada didn't need two black swans to hit it at the same time, the pandemic, and then the oil price war that started with, Saudi and Russia during this time period. I mean, energy in Canada has been a big problem for a while, just given environmental issues and egress issues. I mean, it's amazing some of the things that are happening, but it certainly has weighed on the price of Western Canadian Select crude oil to the point that, it was almost trading close to zero, even when crude West Texas Intermediate was considerably higher at $20 or $30. So it certainly had a tough impact. And I really like John's comment. I may have to steal that. Avoid the stupid, because when you think about everything. Yeah, when you think about all the things that we look at, it comes back to very basic things. What are the fundamentals of the sectors you're following for a particular strategy? Obviously, with uncertainty being high, the fundamentals aren't as visible as they might normally be. We're seeing lots of insolvencies in credit markets. There's a long list of U.S. names seeking bankruptcy protection, and not surprising, whether it's Hertz or American Airlines or J.C. Penney, the retailer. But the second factor is valuations, and that's really important when uncertainty is high. I want to get paid for that. You look at the spread charts we have up here. It's debatable. Their spreads are still wider than where they were, but are they pricing in a garden variety recession? I'm not so sure. They're certainly not there certainly seem to be pricing in sort of a V, a very sharp snapback in economic activity. And again, that remains to be seen. I think the big factor that's really driving and gets back to the Fed, and that's the technical side. They've pumped so much money into this. We're even seeing it for the first time in a long time. If you look at the money supply in the U.S., it's really just exploding, and that sets up for interesting conversations down the road. But, spreads are still moderately attractive. We're finding opportunities, but there's certainly a lot of things going on in the investing market, in equities, especially when you look at the rebound there, where you haven't recovered 75 or 80%. In most cases, you've almost recovered the entire move lower without any visibility around earnings. So again, I like that avoid the stupid and stick with your process, I guess is what I would say.
Yeah, I think that's a great set of advice there. Both avoid the stupid and stick with your process. I mean, in times of uncertainty, in times of market fluctuation, it's the last time you want to just be sort of making rash decisions and jumping from pillar and post to try to match what the market's doing. So I think that's a great bit of advice for those that are on the line, to stick with your process and try to avoid the stupid for sure. So one of the things that you guys started to talk about, though, was opportunity. But I think we'd be remiss if we didn't talk about the historically low and even negative yields that we're seeing in many parts of the world and across several maturities. So, Tom, do you expect interest rates to continue to fall? And where are you currently finding attractive income opportunities?
Yeah, and John will certainly have something to add on the negative yield side. We put up this chart, and we track how much global debt is trading at negative yields. It's been $17-18 trillion. I think it's come down a bit as some jurisdictions have seen yields move higher. Maybe it's 12 trillion, but clearly you can see in this chart there's a lot of red. There's some countries where the entire curve is negative, and the two countries that sort of stand out as high yielders, or I should say four at the bottom: Canada, U.S., Australia, and New Zealand. Yields are low, but compared to the rest of the world, they could seem quite attractive. Now, we could talk about negative yields and what it means, and for real yields, yields adjusted for inflation, because a negative yield is one thing, but if the positive yield is if the real yield is positive because inflation is falling or you have deflation, that's a different type of situation. We don't think the U.S. and Canada are going to cut rates. I mean, they're essentially at the lower bound. The Fed has talked endlessly about negative yields, and I think they're shying away from it. The one thing I worry about, and I could see us calling for the bottom in the 30-year bull market bond, and as we get out of the pandemic, in Canada and U.S., do I think we've probably seen the lows? Probably. Is there some uncertainty around that? Yes, but the one thing, that people have talked about is the Fed could start to target longer-term yields if yields move high enough to tighten financial conditions. So while they're pegged at zero at the front end, they don't have control over, 5, 7, 10, 30-year treasuries necessarily. They can do QE, but could they actually target it? And that's a discussion that's happening and something to keep in mind. As for opportunities, we're not looking at duration and yield curve positioning, necessarily as the primary sort of factor going in to generate excess returns at this time. Canada came into the year really with an inverted curve, which was, high in the front end because of where the Bank of Canada was. Canada rates were following the globe lower, and now you had this crisis, and now, the curve has naturally steepened because the front end is essentially gone to zero. But the opportunity to us isn't really in risk-free Canadian government bonds. We do look at U.S. Versus Canada, and that traditionally has been something that's been attractive. But the opportunity really is still in credit sectors, whether it's high-quality investment-grade names where you're getting a tremendous amount of spread versus very little benchmark yield. So your all-in spread as a percentage of yield is quite high, and that's something that we have found leads to positive excess returns. We've seen some opportunities in fallen angels, names that have been downgraded to high yield during the crisis. Synovus is one that comes to mind. Kraft Food is another, where these big, large market cap in bond terms fall into high yield and the spreads overreact, and that's been a source. But I think where we've mostly focused is high quality, single A, select triple Bs, credit, fallen angels, and things like that where there's opportunity. But, going back to the negative yield chart, just when you think about just the risk-free benchmark rate, there is still an advantage to Canada and the U.S. versus the rest of the world. So let me pause there.
Well, let me jump in, Tom, because a couple of observations. We've been calling, I say we, cause that's a collective we, because I think most bond investors have fallen into that trap, have been calling the peak of the Japanese bond market since about 1995. So that kind of leads me on to the next comment that I'm going to make, which is that, as part of my, downtime, my hobby time is I go out and do some cycle riding. And there's a ride that I did last year, which is a 100-mile ride, and they've got a big hill in the middle of it. And at the bottom of the hill, there was a banner. It said, "There's a hill, get over it." And I think, where we are with negative interest rates, unfortunately, is that, they're there, get over it. Anyone expecting an immediate reversion to kind of 4 or 5% interest rates is I think barking up the wrong tree. I think the historical parallel has to be given I don't think it's necessarily inappropriate to kind of look at this as a wartime equivalent. We are looking at GDP hits of 10 to 15% in some cases, and therefore the post-war recovery phase in which long-term interest rates effectively were capped by central banks and nominal rates of growth or nominal rates of inflation varied around it is, to me, I think, perfectly plausible. So whether you have yield curve control, whether you have flattening yield curves, I think the kind of the old notion that we've got a V-shaped economic recovery, we've got a Phillips curve relationship where wage demands are going to force the central banks to change their interest rate stance is really no longer as relevant a comparator. And I would just echo the comments that you made from a credit perspective, which is that to the degree that within a European sovereign space, you have countries like Spain and Italy, or more recently, we've been adding a little bit in our portfolios to credits like Estonia or to Croatia, have not participated in the same degree of yield curve flattening that you've seen in Germany or Dutch bonds. That perhaps is where the opportunity is. But I think the argument that says that we're reversing back to status quo ante is I'm afraid it's a hill, get over it.
Great thing to see, I'm sure, in the middle of your ride, but a great way to think about where we are when it comes to negative rates. John, I want to just follow up with you because I want to talk about where you're finding opportunities, currently as compared to earlier in the year, and maybe how your frame mind has shifted. Have you just gotten over it in general, the pandemic and the crisis, and are focused on moving forward? So where are you seeing opportunities?
Well, we went into the crisis actually with a duration that was pretty similar to that of the benchmark. So we were not kind of, the global economy is either going to, look, I don't think anyone predicted that the economic cost of the pandemic was going to be as strong as it was, and therefore you would have been fully invested in risk-free, long-duration assets. I challenge anyone to say that they were, in that category. We weren't. But broadly speaking, our interest rate risk invested in countries or in corporates that we think are money good, was broadly similar to that of the benchmark with a slightly high yield. And I think as we come out of the pandemic, we would reiterate some of those views. To a degree, the volatility that we saw in the beginning of the year, I think, reflected that kind of flight to quality. But as I said, the avoidance of validating the stupid was one of those kind of important things that you need to discipline yourself over. I mean, there were liquidity issues as well. So, yes, we come out and Tom has mentioned, some businesses, retail businesses, airline businesses, vacation businesses. I mean, who knows what the future is for sea cruises. I mean, largely speaking, we're not invested in those areas. So I think you have to think in terms of, what makes sense. And if this is, just to kind of give us an example of a credit that we do hold, collateralized landing rights at Heathrow Airport. Well, I can tell you there ain't too many planes landing at Heathrow Airport at the moment because I'm partly on the flight path and I can tell you it's quite quiet at the moment. But do we genuinely think that, in 5 years' time, there will be no airlines flying? And in which case that bond clearly is going to be impaired. But if at the moment this is a 3 to 6 month window of reduced receipt of landing rights that fund the coupon, that fund the final maturity, then, I think we're going to be money good. So I think a lot of what we're looking at really is just kind of maintaining the expectation that interest rates are going to remain low for a long period of time, and just making sure that what we're invested in seems to make sense for, how we may come out of that, the post-COVID era. And yes, look, there are going to be some mistakes that we're going to make, but I think broadly speaking, the economy, the portfolio structure is very sound.
Yeah, thank you guys both for that. I mean, I appreciate you guys sharing your thoughts on sort of the global outlook with a little bit of focus on Canada as well. But this is an ETF-related webinar, so we want to certainly make sure that we talk a little bit about ETFs. Now, I know the Franklin Templeton ETF platform, Liberty Shares, was launched in Canada in 2017. What I find really interesting around fixed income is that it's actually important what team you have managing your fixed income ETFs. We see that whether it's on the passive side or in an active strategy. Tom, I know that you're sort of leading the charge up there in Canada. So how have you built your team? What sort of ETFs are you guys constructing? And how is that providing solutions for advisors today?
Sure. So, yeah, as you mentioned, Liberty Shares is our Franklin Templeton ETF platform. We have actively managed smart beta, passive, single country, and regional ETFs in Canada, the U.S. and across Europe, about $8 billion in AUM. I think there's over 70 total ETFs. In Canada, we started launching Liberty Shares in 2017. We have 16 that trade. On the fixed income side, I mean, we don't manage passive ETFs. We're active managers. All of our Canadian fixed income ETFs are active. Right now, there are 3. The original one that we launched was, the ticker is FLCI. That is an investment grade, purely Canadian, purely investment grade ETF with about $100 million in assets. Our other 2 are more multi-sector, less constrained strategies, that being Franklin Liberty Core Plus Bond Fund, which really mimics our mutual fund, Franklin Bissett Core Plus Bond Fund. That is a feeder fund where, when you buy the ETF, you're buying shares in the mutual fund, and that's really done because there are lots of different levers and things being done within the mutual fund that need a certain capacity around AUM to execute those strategies, whether it's derivatives and active currency management, high yield bonds, levered loans, all of those plus components. And then lastly, we have our short term or our short duration bond strategy, which again mimics our mutual fund strategy. So it's a feeder fund from the ETF into the mutual fund.
That's fantastic.
So I would.
Go ahead. Yeah, John, I was about to say, how would you add, or what would you add to the funds that you're managing as well?
Well, I mean, I would say actually, having been a fixed income manager now for goodness only knows 35 years plus, I've seen a lot of innovation, some of which has been less good, but actually I think ETFs have been a pretty positive, step forward. I think as we went into the crisis, there was this kind of doubt, if you like, that, were ETFs creating false liquidity, and, would we be tested when, we had a crisis? And actually, I think our experience through, the last couple of months has been pretty positive, which is that, the pricing structure has allowed a more accurate reflection of underlying pricing. If you want to deal at the bid side, and we would, urge against it, given some of, as I said, avoidance of the stupid, then the kind of the flexing of the NAV, I think, has been very beneficial. So I actually think that the advent of the ETF has been really quite beneficial for liquidity in markets, for fair pricing for those that enter. We entered mid-March. I don't know whether I mentioned on the call, my wife is a doctor, so she is actually a chest physician, so we had a little bit of insight in terms of what might be coming down the pike at us. And not that you can get out of the way entirely, but it was a case of, right, this could be a little bit worse than we think, so we had sufficient liquidity. But really, we had no major problems of pricing, and I've been pretty happy with how things have panned out.
That's fantastic, and great to hear. Again, it's awesome just to see, folks with such experience getting into the ETF space and bringing that expertise to a really innovative product. I have a bunch more questions, but we're starting to see the questions from the audience pile up, and I want to make sure that we get their questions asked and answered. So I'm going to pivot right now, and I'm going to actually start asking some of the questions from the audience. So this one you guys may have slightly answered, but I think they're looking probably for a little bit more of a direct answer. But with so much uncertainty in markets, should clients look to active strategies to gain control or use passive and ride the wave? And I think, John or Tom, you guys could select who wants to answer that. But why don't we hear from Tom, since John, you just you finished up the last section for us.
So sorry, the question is between active versus passive. Did I get that right?
Yeah, so Tom, what they're really asking, I think, is, hey, is it better to be active right now and try to control my own destiny, or is it better to just take a passive product, ride this out for a while, let the sort of, chips fall where they may, and then move forward from there?
Yeah, we're obviously big believers in active, and as unconstrained as, a particular strategy would allow. The Canadian bond market is small. It's very narrow in breadth. If you take just federals and provincials, you're nearly 80% of the bond market in Canada, the remaining being corporate bonds. There's not a lot of breadth even to the sector, so we find tremendous value in a core plus strategy where you can look at global high yield markets, mainly the U.S., levered loan markets, derivative strategies to switch your duration exposure from the U.S. to Canada, hedging strategies to hedge credit risk, active currency strategies, all those things. None of that happens in a passive portfolio. What we have found, and empirically the evidence shows, while it seems like you're taking more risk, say, with high-yield bonds or levered loans, the volatility, the standard deviation of the price of, say, our Core Plus bond fund has actually fallen. It's lower than that of the universe index, the Canadian bond market, as it were, but the returns are higher. So the risk-adjusted returns go higher when you do that. Now, obviously, if you focus on a very small time frame, February, March, April, May of this year, which was technically in Canada a 10 standard deviation type event, you're going to suffer some underperformance. So, we encourage everybody, all investors, to have a long-term focus. But I think active is really important when it comes to duration management and yield curve management and, all those different factors. And John can speak to this, but in a global market context, do you always want to have the highest weight to the most indebted issuer? And the same can be said in credit.
Tom, I was itching at the bit to get in. I was itching at the bit to get in because I think there are two reasons that obviously we've overacted. I think the first thing that we would say is that the whole basis of investing in global fixed income. And one can say, look, the global pandemic has affected all countries, broadly the same, but there are different economic cycles. There will be different economic cycles as different countries come out of this. And to a degree that there will therefore be different interest rate responses from central banks, you want to be able to exploit that. And if you invest in a passive strategy, you know that you can't. So that's one reason to start off with. Let's choose the best countries to either go in or come out of the strategy. But the follow-up thing that I would say so strongly, we've talked a lot on this call about kind of risk-free pricing. If you want to buy a passive strategy, you can, by all means, go ahead and buy 10-year German government bonds at a negative yield of 30 basis points. Buy the whole of the Swiss yield curve at a negative yield. If you want to validate that, then that's a passive strategy. So, we think there are two very strong arguments for an active approach, and we very strongly stay with that.
Makes a lot of sense. So we want to keep moving along here with questions from the audience. I do think you're right with that active approach within fixed income. You're seeing a lot of the most popular ETFs in the fixed income space typically be some of the active products outside of the ag and things like that just have a little bit of a head start on them. But what they want to talk about next year is they want to talk a little bit about defaults and downgrades in triple Bs and in high yield bonds. And I actually like that question because one of my questions was around high yield debt and that sort of stuff. So do you guys expect there to be a lot of defaults and downgrades? And why don't we start with you, John, this time, since Tom took the first one?
That's rather like playing on the Canadian rugby football team when you've just met, a big Australian who's about to flatten you. So thank you for that question. I come back to my question about uncertainty, which is that, there are clearly going to be levels of default. I think I come back equally to, one of the earlier slides that we showed, which is the validation of the spread levels at which you're looking at, because you have to deal with the now. And, as I said, cruise lines, we haven't participated in cruise line, refunding because we don't think that business makes a lot of sense. We don't know what the outcome is going to be for the oil price. That will affect the Canadian dollar as it might affect more kind of emerging market sovereigns. We do have some very limited exposure to some in that category. But I think equally you would have to say that, do you think that we are in a fully fledged default situation? No, I don't think we are. But, I think it would be naive and, as we already hear bits of news coming out of, voluntary agreements and restructuring and so on and so forth. I think it is inevitable that there will be defaults. But, the question is whether it is overly priced in some of the spreads that we're currently seeing. I would say, just as a final point, that the FLGA, the global aggregate strategy, is so heavily predominantly invested in the investment grade spectrum that, it really is at that sort of tail end of the normal distribution where some of those events are likely to happen. If they do, that is, of course.
Yeah, and I can follow up with that. Clearly defaults have been historically low for this post-crisis period since 2009 forward, and the Fed programs, QE, and all the reality that the markets were open and companies can borrow, definitely extends that sort of low default rate. Right now, we're seeing a number of companies seek protection, like a Hertz, American Airlines, JCPenney. Some of those companies may go out of business. Some it may just be temporary until, revenues come in. Typically, companies go default because they can't refinance their debt. Here you have companies that, have a lot of debt, but the economy shut down. There's no revenues, so it makes sense. I think if you look at pricing of high yield, like on the upper left-hand chart here, we're just showing the whole index. But if you take the distressed names, they're not being priced at 500 to 700 basis points over. They're well over 1,000 basis points. So the market is discerning between, those names that are of higher risk of, default or non-payment than it is, the rest of the market. Like John, even in our Core Plus strategy, if you ask me what our exposure is to sort of problematic names, it's probably well less than 1% of the entire AUM of the portfolio, maybe 50 basis points. And that would be a couple of Canadian energy names. Are there going to be defaults there? Absolutely. Some of the higher levered names will default. It's not something we have really exposure to in our portfolio. We have no retail, no cruise lines, really no airline exposure, things like that John had mentioned. So we're quite comfortable with it. There's going to be some problems, and there always are, but the Fed is obviously doing its darndest to ensure that it's a smooth transition. So these programs, do lift all boats. When we look at supply, the amount of money that's being issued, it seems almost anybody can borrow money, whether it's Delta Airlines, American Airlines, Carnival Cruise Line. I mean, all these companies recently have sold bonds. I mean, the coupons and yields are very high, 8, 9, 10, 11%, but they are getting the money they need at this moment.
That's fantastic. So a couple of questions here. We're just about out of time, so we're going to have to do our best to answer these as quickly as possible. Let's see here. I'm just looking between a few of them to make sure that we get the best of them. We don't ask something that already has been. So we do have one here for John, and it's as the mutual fund managers, how do you think differently about managing mutual fund versus ETFs? And if that's something you could do maybe in 30 seconds or a minute, we might be able to get to the next question as well.
We have a regulator in the UK that talks about treating customers fairly, and to be perfectly honest, it doesn't make any difference whether it's a mutual fund, whether it's an ETF, or whether it's an institutional client. So that would be my kind of, there you go response. I really don't see any difference at all in terms of how you run those types of portfolios. Clearly you do try to. It's something that actually I think I'm very proud of. But we didn't need to have any sort of tightening of the price or abandonment of daily NAV, because we had sufficient liquidity that we could always make any redemptions if we needed to at the price at which the NAV was struck on that day. The NAV structure, the ETF structure, did allow some variability in that, but we always had the liquidity there. So I come back to our regulator: treat customers fairly. There's no difference in terms of how you manage those portfolios.
And I agree 100%.
Well done.
That response.
Yeah, well done to get that in a minute. So, Tom, we actually have the last question is for you, and again, just about a minute. So, I have a highly selective process and only consider products with the top Morningstar rating. Do any of the ETFs that you've discussed today have a 4 or 5-star rating? And I'm not sure if you know that off the top of your head, but there have been. That's one of the most popular questions that's come in.
Well, I know FLCI, I think, just got rated, and that's our Franklin Liberty corporate strategy. I believe just was rated with 5 stars. Our Core Plus bond strategy has been 4 or 5 stars for most periods. I think the 1 year, because of what just happened here in the last few months, it may have gone from 5 to 4. But we can get you all the ratings for all the various strategies that are listed here on this particular page. Oh, it didn't.
And I think FLGA doesn't have the history to meet the scoring criterion yet. So.
Well, gentlemen, I think that that brings us to the end of our webinar today. I want to thank both Tom and John for their insight and their thought leadership with us today. I want to thank everyone who has submitted a question. I think we got to just about all of them. I want to thank those that have dialed in and listened to this webinar. Again, if you're looking for a replay of it, you will get an email within approximately 24 hours with a link to go ahead and view that replay. In addition, I would remind everybody that at 1 p.m. today, we're actually going to be taking a look at the equity markets and the global uncertainty that's taking place there. So please do join us at 1 p.m. today for part 4 of our 5-part webinar series, exploring ETF solutions in today's uncertain times. Again, that is at 1 p.m. Eastern Standard Time. So again, thank you to everyone that joined us. A very special thank you to Franklin Templeton for helping support our educational ETF series here in Canada, we do appreciate the support and look forward to talking with everybody later today at 1 p.m. Thank you and have a great day.